Over the last year, global inflation has grown from less than 2% to over 6%, the highest level since 2008. In practically all advanced countries, and the majority of inflation targeting emerging markets and developing nations, inflation is currently running substantially over central bank inflation objectives. Inflation will rise further in 2022 as a result of the current commodity price jump caused by Russia's invasion of Ukraine. Warren Buffett has been thinking about inflation for a long time. The 91-year-old investor had the dangers of inflation drilled into him by his Republican Congressman father, according to biographers, and has repeatedly commented on the subject throughout his investing career. "We're seeing very substantial inflation," Buffett said at last year's Berkshire Hathaway annual meeting. "We're raising prices. People are raising prices to us, and it's being accepted." The year is 1970. The stock market is in shambles. Over a 20-month period, it has lost over half of its worth. For over a decade, few individuals have wanted anything to do with stocks. During the late 1970s and early 1980s, when the United States was experiencing substantial inflation, Warren Buffett spent major amounts of his Berkshire annual letters outlining what rising prices meant for equities, business balance sheets, and investors. Buffett lived and invested during a period when inflation reached 14% and mortgage rates reached as high as 20%, dubbed by some as the worst American macroeconomic failure since World War II. Warren Buffett has long maintained that keeping invested in equities is the only option. Buffett, the chairman and CEO of Berkshire Hathaway, is famed for making the ultimate dip-buying statement: "Be fearful when others are greedy, and greedy when others are fearful." But these Buffettisms may mask the fact that throughout his life, Buffett has offered many wise words on just how much inflation can ding stocks. Now that inflation is back in the crosshairs of the markets, as investors try to understand what has caused such a swift correction in stocks, it's worth looking back at what Buffett has said about inflation in the past. He never lost focus on, or the fear of inflation. In June 2008, as the price of gas went above $4, Buffett said exploding inflation was the biggest risk to the economy. "I think inflation is really picking up," Buffett said on CNBC. "It's huge right now, whether it's steel or oil," he continued. "We see it everywhere." Do you remember what happened after that? As the Federal Reserve resumed its quantitative easing program in 2010, Buffett issued the government a thank you note in the form of an op-ed for its efforts during the crisis, rather than its paralysis or politicking. But that same year, he cautioned, "We are implementing policies that, unless modified, would eventually lead to a lot more inflation down the line. We started down a path you don't want to go down," he added. As the markets plummeted during the last 2 weeks, headlines claimed that the end of the central bank's easy money period was now sinking in. Buffett had earlier warned at the 2013 Berkshire Hathaway annual meeting, "QE is like watching a good movie, because I don't know how it will end. Anyone who owns stocks will reevaluate his hand when it happens, and it will happen very quickly." Buffett articulated his thoughts on inflation in a famous column for Fortune magazine in 1977. The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislatures. The inflation tax has a fantastic ability to simply consume capital. If you feel you can dance in and out of securities in a way that defeats the inflation tax, I would like to be your broker, but not your partner. The globe and economy have changed dramatically since Buffett's yearly letters to Berkshire Hathaway shareholders addressed inflation and investment. The income tax rates have shifted. Bond yields were substantially higher back then, as were savings rates, and these are only the beginnings of inflationary pressures. The increase in salaries in the most recent non-farm payroll report jolted markets. And in the most recent statistics, reported on Wednesday, February 14, the Consumer Price Index rose more than predicted. Other economic elements are eerily similar, or at least largely so. During the Vietnam War, the government's fast expansion of the federal debt kicked off an inflationary cycle that peaked in the late 1970s. According to the most recent calculations from a government budget monitor, the yearly deficit would more than quadruple from what was predicted just 2.5 years ago, $600 million, to $1.2 trillion in 2019 as a result of the tax cuts and recently approved expenditure package. It's worth remembering that the worst stock performance of the 1970s came not when inflation peaked, but when it first spiked rapidly. From 1972 to 1973, inflation doubled to more than 6%. By 1974, it was 11%. In those 2 years, the S&P 500 declined by a combined 40%. How to beat inflation, according to Warren Buffett? With prices on the increase, it's worth revisiting some of Buffett's finest advice for dealing with what he famously called a gigantic corporate tapeworm. Number 1. Invest in solid firms that require less money. Buffett has long pushed for holding firms that provide large returns on money invested. During inflationary times, firms with minimal capital requirements that can sustain their profitability should perform better than those that must spend more money at ever greater costs just to stay in operation. Buffett once equated the challenge posed by inflation to running up a down escalator. Number 2. Look for businesses that can raise prices during times of high inflation. Buffett told the Financial Crisis Inquiry Commission in 2010 that the single most critical choice in appraising a corporation is pricing power. You have the ability to raise your pricing without losing business to a competition, and you have a very excellent business. If a company can raise its pricing, it has a significant advantage during periods of high inflation because it can balance its own rising costs. Buffett famously stated that in an inflationary society, an uncontrolled toll bridge would be the best asset to possess since you would have already built the bridge and could raise prices to balance inflation. You construct the bridge with old money, and you never have to replace it, he explained. Number 3. Check out TIPS. TIPS, or Treasury Inflation-Protected Securities, are another Buffett-recommended investment for investors concerned about increasing inflation. TIPS pay a set interest rate twice a year to investors, but the principal amount is updated for inflation using the Consumer Price Index. Number 4. Invest in yourself so that you can be the greatest at what you do. Buffett reminded shareholders in 2004 that investing in one's own ability is one of the finest ways to sustain buying power over time. The top surgeon or lawyer in a city or town benefits from an education paid for in old money, but may charge current dollars for their services without having to re-educate themselves. Consider adding a new talent to your CV by attending a local college or studying a new skill online. Advanced degrees might be costly, but they can also help you expand your expertise and make you an indispensable employee in the future. Increasing your worth to your employer and its clients will enable you to command a reasonable amount of your profits over time. Number 5. Stay away from conventional ties. Bonds are not the place to be these days, Buffett noted in his 2020 shareholder letter. Bond investors may suffer severely if interest rates remain around historically low levels in an inflationary scenario. Buffett has stated that buying a 10-year bond producing 2% is comparable to paying 50 times earnings for a corporation, with the important distinction being that the bond's earnings cannot expand. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future, Buffett said. That's all we've got for you today. What are your thoughts on this? Let us know in the comments down below. If you liked and found today's video fascinating, please give us a thumbs up. Don't forget to subscribe to our channel and click on the bell icon to be up to date with the most exciting things as soon as it's released. Thank you for your time. See you in another video shortly.